Hey guys, welcome back to Chapter 3. This is job order costing. This is dealing with cash flows and external reporting. So, when we talk about job order costing and the flow of cost, it really starts, uh, job order costing starts by tracking costs at the individual job level and following the flow of costs through the accounting system. So, costs move through three key inventory accounts. It'd be raw materials, it'd be work in process, it'd be finished goods. Um, so the different steps in the flow of costs, there's the raw material inventory first. So the purchases of raw material would go here. So maybe you need lumber for a house or roofing or something like that. You write a check and you end up putting that in your current asset inventory account. Um, it stays there till you use it. You may have a big pile of raw materials. But once you start to convert that material into the finished product, it goes into a work in process WIP account, CWIP, construction work in process, um, inventory account. So the direct materials and the direct labor are both added into specific jobs within the work in process account. Um, Overhead is applied to each job at a predetermined rate. So, you have a custom house that you're building, and that's sort of how that would be put together. Um, the finished goods inventory, completed jobs are transferred from work in process to finished goods. The example would be completed custom tables, homes that are ready to sell. When that home is ready to be sold, you can go ahead and move that into finished goods. It's ready. You're ready to turn over to the new homeowner. You just need to have the sale executed. Um, Cost of goods sold. When a product is sold, the costs are transferred out of the finished goods into the cost of goods sold statement. So it comes off the balance sheet, goes into the income statement. Up at the top, when you sell it, your revenue line, and then you have a cost line, they have gross profit. So I know we've mentioned that throughout the class, but it never hurts to sort of reaffirm that same image of what's happening here. But ultimately, the costs are tracked and transferred through these accounts to ensure that the financial reporting is accurate and proper decisions can be made by management. So there's a couple schedules that are used. There's a schedule of cost of goods manufactured and a cost of goods sold. So the cost of goods manufactured statement, the purpose of that statement is to summarize the total costs manufactured during a particular period. So you have to figure out what all has occurred during that period and you need to assemble it. So the components of it, you would have your direct materials used, which you would take your beginning raw material inventory, you would add any purchases during the period, and you would subtract the ending number, and that would tell you what was used. So you started with this number, started with 1,000, you bought 5,000, you were left with 2,000. So 6,000, 1 plus 5 is 6, minus the 2 would mean 4,000 was used. So that's sort of how you figure it out. Direct labor costs are directly traceable to specific jobs. So when somebody works on a project, those labor hours, they go directly into that. Then you have manufacturing overhead applied. This is allocated using a predetermined overhead rate. So whatever that rate is, you would multiply it out and you would add an overhead component to that cost. And then you get your total manufacturing cost. This would be the sum of the direct materials, the direct labor, and your applied overhead to a particular job. So your cost of goods manufactured would have your total manufacturing cost that you just added, plus your beginning work in process inventory, minus your ending work of process inventory. Same concept there. You started with a work in process here, you added it to a certain, you performed a certain amount of work, you were left with this. Well, now you know your total cost of work in process, and you add that to your total manufacturing cost to get your total of cost of goods manufactured. All the work that was done in the period. So if the total manufacturing costs are say $100,000 and your beginning work in process is 10,000 and the ending is 5, then your cost of goods manufactured would be the 10 minus the 5, which would be 5,000 plus the 100,000, so you'd have 105,000. Um, the schedule of cost of goods sold. The purpose of this is to reflect any of the or reflect the actual cost of goods that were sold during the period. So one is the cost of goods manufactured. This is the cost of goods sold. Once produced, this is revenue. But the components would be the beginning finished goods inventory plus your cost of goods manufactured minus your ending finished goods inventory. And so at the beginning inventory is 200,000, or sorry, 20,000, and your cost of goods manufactured is 105, and the ending inventory is 15, and your cost of goods sold would be 110,000. So you know that there you ended up leaving a little in, uh, or in that sense, you have a cost of goods sold 110. So those schedules provide a clear view of production cost and inventory flow, supporting the price and cost control decisions. Then there's something out there called underapplied and overapplied overhead. And so overhead is considered underapplied when the overhead applied to jobs is less than the actual overhead incurred. We didn't apply enough. And it's overapplied when it exceeds the actual overhead incurred. Like you put more in overhead than there was actual overhead um, for the job. So sometimes these differences can occur because estimated and actual overhead costs may vary from what actual is, and then variances in the activity level um, are also used to apply overhead. It could be another reason. We would adjust for any under or over applied inventory. We would adjust the difference to the cost of goods sold. So if the under applied overhead is 5,000 and you add that to the cost of goods sold, if it's over applied, you would subtract it from the cost of goods sold. The prorated method would allocate the difference between work in process finished goods and cost of goods sold based on their relative differences. So you could allocate it based on a percentage to each of the three categories. Um, Managerially, identifying the under and overhead applied overhead helps refine the future estimates, and it ensures accurate financial reporting and aligns the cost application with the actual resource usage. Ultimately, sort of thinking through all of this, job order costing ensures costs are accurately tracked through raw materials, work in process, finished goods, and cost of goods sold. The cost of goods manufactured and cost of goods sold schedules provide vital summaries of production costs that support the financial reporting and internal decision making. Um, Being able to understand the under applied and over applied overhead allocates allows for accurate cost adjustments and improved overhead estimation in future periods as well. But by aligning the cost with activities and outputs, job order costing enhances managerial insight into operational efficiency and the profitability of the business itself. So that's sort of a broad overview of the different, uh, just the job order uh, costing and the way that cash flows and the external reporting all sort of flow together and why it's necessary. But understanding your costs, you can't really be profitable if you can't identify what it's costing you to make a product. So you've got to know that first. That's why this is so critical. Regardless of the different way or approaches you use, it is very critical. Hope that helps this week. If you guys have any questions, let me know. I'll be glad to work with you. Talk to you soon and have a great week.